Retail investors are still not as bullish on the markets as they had been. According to the latest weekly survey by the American Association of Individual Investors, sentiment is below 30% for the fourth straight weeks. And our next guest says retail investors want to participate in the markets but don't want to have to pick individual winners. Are we back to sort of like post-financial crisis? I don't believe it. Joining us right now is J.J. Kinahan, the newly minted CEO of IG North America. Can I call you the OG? JJ, it's nice to see you.
Good to see you, Andrew. I like
what's happening here? Because, the last time we had that kind of conversation, the one I just introduced, it was sort of post-financial crisis. People said, we hate all of this. We're just going to buy mutual funds. We can't be bothered to buy individual stocks. Is that what you see happening here?
No, I don't want to go to that extreme at all, Andrew. I think what you're seeing, though, is interesting in that if I look at the mix of what clients are buying, you think about what we're coming off the last 2 years. So many individual stock stories that were fun or exciting that people wanted to be involved with. You look now, and there's not those individual names that get people excited every single day. So what's happening is people going to the index-based ETFs in a much bigger way, the SPDR, the QQQ, IWM. So we're not seeing that preponderance of individual names because, again, I think there is confusion as we're in this time of, we see if we get inflation confirmed here later today, but also with the war, et cetera, in Ukraine, what's the name or even the sector that comes out as the winner? Because the other part of this, Andrew, is we're not necessarily seeing that bump in those sector ETFs, which you may expect. It's much more full market. So I think that's really the question individual investors have right now is what is the winners? And it's not like they're dumping all their individual names. So I don't want to make it sound that way. It's just the mix of what they are buying has changed.
Can you speak to this? We just were having a debate at the table. I don't know if you heard it about gold. Price of gold has not moved. It's not even that it hasn't moved. It's actually become sort of a negative scenario in an environment where it shouldn't be, right?
Right.
What do you think is happening there? And gold was always pushed in part by individual investors, I would argue.
I actually think that's a good point. I think they've lost a generation, if you will. And what I mean by that, Andrew, is, when I was younger, you had a lot of younger people trading gold also, as well as those who have been gold bugs forever. I think what's happened is so many of the younger investors have put that money toward cryptocurrencies, be it Bitcoin or Ether or whatever it may be. So it's very interesting because, again, as we've heard many say, I don't know that it's necessarily been proven by any stretch of the imagination, that Bitcoin was going to be an inflation hedge. So I think what happened is those who may have bought gold in the past for an inflation hedge have now turned toward Bitcoin and just aren't as interested. The amount of gold futures that we see traded is pretty low overall for what you would expect in this type of environment.
JJ, for those investors out there who don't want to buy individual names, as you were just discussing, but do want to, quote unquote, play the market, when you think about the ETFs, if that's the way you want to do it, or even an actively managed mutual fund, that's the other piece of it we haven't talked about, sort of the popularity or lack of popularity of the actively managed mutual fund. What do you think investors should be doing?
Well, I do think overall, Andrew, two things. Number one, playing those ETFs aren't a bad idea overall if you're not sure where to turn. But the other thing is I think there are still great companies that you can buy right now and say, okay, rather than going in fully, if you have, we'll say, 400 shares of a company to buy, start with 100. See what happens from there. If we go lower, you can buy more at a better price. I think the individual investor often thinks all or none rather than in partials. And professional investors almost always think in partials and things they do. So I used to always joke, maybe that's why some of their marriages are pretty short, as they think in partials. But quite honestly, it's really all about the scaling in, scaling out, I think is the best piece of advice any retail investor could get at any time. Some will say, well, what if I buy something and it rallies immediately? I guess my argument back to that would be I don't think that's been any individual investor's biggest problem is they were too ripe too quickly.
Shepard Smith here. Thanks for watching CNBC on YouTube.